we're all going to be focused on this. Haven't had data for ages. What is it going to tell us?
Yeah, I mean, this is the hard bit, right? We have inflation data coming in. I think the feed through to the equity market, the main channel is how it impacts your expectation for Fed funds.
Yep.
So what you tend to see is if you get a hotter than expected inflation print, that means you need a higher discount rate. That impacts earnings and therefore equities to the downside. Whereas if you get a downside surprise, you get the opposite impact. Now, the bad news is I think there's a much higher bar to price in more dovishness for the Fed than more hawkishness. So you have a terminal rate currently priced that's 3%. That's in line with dots. That's essentially where the Fed sees neutral at. So to go more lower than that or more dovish than that, you have to say essentially you're entering recession territory, which seems unlikely but also isn't great for stocks.
Yep.
Whereas you have an ability to price in more hawkishness. What I would say, though, in terms of good news, is that the expectation is quite high. So implicit in that is this idea that the market assumes the Fed is putting more priority on the labor market rather than inflation. So if you do get a hot print, you might just see a wobble in equity markets rather than something bigger, especially given that you won't have the Fed coming out. They're in their blackout period. You won't have any kind of like hawkish commentary to go with that hotter print.
I was on WEI, not WEIF. Just going to point out the futures are up a little less than I said. 0.4% on NASDAQ.
You're talking about the equities market. Talk to us a little about the bond market here. I'm looking at 3.99 on the 10-year. It's kind of been in like a weird 5 basis point range, I want to say, all week long. Does this print change that?
I think it's really hard for this print to change it because there's so much emphasis being put on the growth story, on the labor market, because there's this idea that inflation, if it's tariff-driven, might be transitory, which seems like a big mistake given that we've had this transitory inflation story before. I will say you got a little bit of a feed-through in terms of higher oil prices, higher break-evens. I do think at some point either you need to price a higher Fed funds, which pushes up your real yield in terms of terminal, or you need to admit that you're not going to get back to 2% inflation anytime soon, which means your break-even rises. So I think certainly you need to see higher yields as inflation comes in hotter. I just don't necessarily think that comes today or even really in the near future until we get some kind of sign that inflation isn't just going transitory, it's actually having longer term impacts.
Skylar, it's a big week next week. There's a lot of weekend risk with these U.S.-China discussions. Do you think there's a risk you could just see profit taking after this report, regardless of what it is?
Yeah, I mean, this is the thing with valuations is by themselves, they don't predict your equity returns whatsoever. But what they do is they make investors more nervous. So what you tend to see is when equity valuations are elevated, they stay elevated for long periods of time as earnings come in strongly in an expansionary period. But when you do get a sell-off, the sell-off tends to be harder. So I think it's a reason rather for vigilance instead of selling off altogether. And it's something certainly you need to pay attention to is that negative catalyst.